Well, greetings everyone, and welcome to this month's Investment Strategy Brief video. For the last few months, this has really been a COVID-19 update. Obviously, the coronavirus crisis is what's front and center for us and how we're dealing with that. So let's jump in. This first slide, slide 3, really speaks to what we've all been talking about for a number of months now, which is the slowdown. We basically stayed home, shut down businesses, all to slow the spread of the virus. And that's generally been pretty effective, but of course that's come at an economic cost, which we're going to get into. And, an interesting way to look at it, though, we've actually just profiled here on slide 4, two specific states, California and New York. And it's sort of known that New York didn't shut down soon enough. I think the virus was spreading, especially as it relates to trains and the subway system. And you can see the shape of the New York experience was a quick acceleration of the virus. These are sort of daily new cases, whereas California shut down very early. And so what we're seeing there is just a very flat curve, and it just continues chipping away in terms of California. So what we're expecting here is for New York to sort of settle down more quickly as a result of all that, and for California for things to be a little extended. Now, another thing we're monitoring is the weekly change in different data. One of them, unfortunately, is mortality. Think of it as how many deaths occur in each state each week, and then we're really looking for a decline. So here's a chart that shows the range really from almost down to elimination, a negative 100% to 100% growth, and everything in between. And what you take away from this is the very light blue states are in a pretty good spot. The darker blue states, not so much. And again, this is just something that day in, day out, looking at back over the last week and then the week prior, we're just going to keep monitoring this. That's in part because when we look at the guidelines for opening up America, these are the sort of the federal White House and CDC guidelines. We're reminded that basically we're looking for improvements. So think of it as 2-week intervals in terms of cases coming along and sort of symptoms coming along, and the hospitals being able to handle things. Then you work your way into phases. Phase 1, a slight opening. Phase 2, middle of the road. Phase 3, much more wide open. And what we're seeing, of course, around the country is that states are sort of taking this general guideline set and then adjusting it for their specific circumstance, which was exactly the intention. The net result of this is that we're seeing a number of states start to reopen. And so here's a graphic that just, again, color codes it. From light, basically states that are essentially shut down, and then the darkest green here are states that are pretty open. And what's interesting about it is you see the middle of the country generally is opening up more quickly. The coast, especially the West Coast, is staying a little bit shut down. And again, we're just going to see this change day to day, week to week as we look forward here. So obviously what we're all watching is, number one, how things are going as we reopen, and number two, whether the virus starts to reappear. Now, another thing that's been happening, of course, is medical advances. There's a number of companies that are fighting hard to develop vaccines and therapeutics for this virus. And there's been a little bit of news over the last couple of weeks. A good example being Moderna coming out with a sort of an initial test of a vaccine that looks kind of promising. So what that means is that, number one, they're going to start to accelerate the phase 2 and phase 3 of the testing, but also I think they're already looking to develop sort of the production of this vaccine. So again, it's a number of months before we'll know for sure, but that was one sort of nice glimmer of hope that we saw. And there, again, that's one of many, many companies working hard to develop a vaccine. So we'll keep track of everything else that's going on. Now, the market impact, we've talked about this here on page 10, equities, and actually this month I put in fixed income as well. Essentially, we knew in 2019 there was a little volatility, but we ended with a very positive year. We started 2020 in a modestly positive space, and then that rolled over with the fear of the virus. And then since then, the market's climbed back. And taking the S&P 500, for example, as of this recording, it's back almost 2/3 of the way to where it needs to get to be back to even. And again, I think by inserting the taxable bond market, the investment grade market here in the last row of these two tables, just shows you sort of the benefit of asset allocation, that those returns generally are not correlated with equities, and that helps with a blended portfolio. Now, here's a graphic, page 11, that sort of shows the linear path of the S&P 500, for example, and correspondingly investment-grade corporates, the spreads on those, and then interest rates as defined by the 10-year Treasury. And we all know the story, basically. There was that decline We've seen some recovery. We've seen rates fall, which we'll get into in a second. And I think, again, another thing to note is that choppiness of the S&P 500 chart, just showing that the day-to-day volatility is quite increased. Now, looking from a valuation perspective, which we cover each month, you can see that as it relates to the U.S. markets, by looking at historic earnings, we're back to about even with long-term valuations in a PE sense. But when we look forward to the coming 12 months earnings, if we just use that measure, markets are pretty heavily valued. Now, this is an unusual environment because earnings are getting impacted hard, and yet we expect quick recovery. So I think that sort of that rich valuation measure in the upper right here of page 12 maybe is a little overstated. Page 13 reminds us of the history that we've seen through a variety of different viruses and outbreaks. And obviously, as we've discussed before, COVID-19 was a much more dramatic reaction by the market, in part the result of, number one, markets having had a very strong positive run, but number two, the unusual sort of severity of this virus in the sense of, number one, how easily it spreads, and number two, the impact on people who ultimately get hit really hard. So it put obviously a strain on the healthcare system, caused us all to shut down. Markets don't like that in terms of the economy slowing. Page 14 reminds us that bull and bear markets come, and we've had an extended run up until this most recent move down, and kind of the most recent, therefore, bear market after a very extended bull market over almost 11 years. And so again, while this has been tough, we know markets are cyclical. We expect markets eventually to recover. In fact, page 15 reminds us this is every 15% down move in the S&P 500 since back to the late 1920s. And you can see here that that there's always a very positive sort of move back up the subsequent 12 months. All the green bars on this page fully recovered. They recovered in less than 12 months. And those that were gray, you can see how much they recovered, but then how long it took to get back to even in each case. And the bottom of the page, of course, is where we are today. And again, as I mentioned, we're about 2/3 of the way back to recovering, almost 2/3 of the way back to recovering as measured by the S&P 500. And then when we move to page 16, this is a new slide this month, basically sharing with us the impact of asset allocation. At the top of the page is 100% stocks, where you can see the lowest return for stocks over this period. This is a 12-month rolling return, and then the highest return for a 12-month period in this history. And then the middle bar is basically the average over this period. The bottom of the page is 100% bonds, the same thing. Lowest return, highest return. Obviously, we can see here the bonds are a lot less risky, and then the average return over that period. And then you can see all up and down the page basically the difference as you blend from fixed income to equity. You're increasing risk, increasing your average return, and people tend to pick where they want to fall on that continuum of stocks plus bonds. Now, turning back to sort of the macro environment, here on page 17, we show this chart each month, and it covers macro discussion, the market environment, themes that may be developing, but I want to just focus on headwinds and tailwinds. At the end of the day, the headwinds here are all about the virus, the slowdown of businesses, the shutdown of businesses, the slowdown of the economy. And then really the tailwinds are all about both support we're seeing, especially from the federal government, and then recovery, support in terms of Fed and sort of fiscal support, and then recovery, watching for things to reopen and what kind of tailwind that will create for the markets as that all unfolds. So turning on to page 18, here we move to our coronavirus dashboard. And basically, we as you'll recall, we identified a bunch of measures to start to try to track the impact of COVID-19 and the slowdown on the economy. Here on page 18, I'll point to two things. First, the Bloomberg consensus GDP for 2020 at negative 5.7%. That's for the U.S. And then just to pick another, the IMF World estimate for global GDP in 2020, negative 3%. Both of them not good numbers, basically a decline in the U.S. and the global economy. Turning to page 19, here's a bunch of other measures. Let me focus a little bit on the consumer. So consumer confidence is key. We're going to talk about that. And it's fell a bit, but it's holding up some, interestingly, because the consumer has some optimism looking forward. Everybody's anticipating the reopening of the economy. Now, this next slide, we used to just simply call our recession checklist. We've evolved to recognize that we're now monitoring it more to look for improvement, i.e. recovery. Now, it's a little bit of a lagged indicator set, but you can see here we have a variety of measures from financial to inflation to the consumer and business activity. And there's a lot of sort of expectations of recession. We're in a recession, so lots of red on the page, and a lot of caution, a lot of yellow. So these are all measures that we're tracking, waiting to turn back to the green, if you will, in terms of recovery. So let's turn back to the support from the government. So here's a chart, page 21, that basically focuses on the fiscal support that's been provided. So basically, almost 2.4 or more trillion dollars in support to make up for both job losses and the impact on businesses in specific industries like airlines. So that's obviously been a historic level of fiscal support. Page 22 talks about the Fed. Basically, the Fed cut rates to very low levels. They've offered market liquidity, basically stepping in and transacting in different markets and providing liquidity. And then as lender of last resort, a variety of lending facilities. And then page 23 basically sums this all up, kind of gives you a sense for the magnitude. And in fact, at the bottom of the page here on page 23 is a profile of a bill that the House has passed, totaling another $3 trillion in fiscal support. Now, we actually expect that to be not to just fly through. We think the Senate and the administration will push back on that. There's certainly a very large group in the federal government that believe they've done enough for now. They want to watch things for a while before additional support is provided. But again, that bill is sort of in motion and being looked at. So let's talk about this a little bit from an economic perspective. So page 24 shows us sort of historic GDP prints and then a breakdown of most recent GDP. And as always, I point to that big sort of light blue box, consumption. That's the consumer. What that's telling us is even still the consumer is a hugely important part of our economy. And so if we turn to what's happening with the consumer, page 25 tells us where we are in terms of employment. We'd come pre-virus from a period of very strong employment. Now we've seen unemployment jump to 14.7%. We think it's going to go higher from there. And the cumulative jobless claims over the last 8 weeks is 36.5 million people out of work and looking for work. So huge numbers. We all know that jobs have been impacted. Page 26 tells us that has been true across the sort of education spectrum, but interestingly, and maybe not surprisingly, college-educated folks have been better employed, and the impact on them has been a little less. There's still a negative impact, but a little less than other levels of education. So in terms of kind of areas that have been hit, page 27 shows us as it relates to earnings and spending and employment. Obviously, industries like hotels and tourism, airlines and cruises, entertainment, restaurants, bars, these have been hit really hard. And so you get a sense for their role in the overall earnings of the market, their role as it relates to consumer spending, and their role as it relates to being an employer. And in fact, when we look at a group we've just sort of selected to illustrate this, when we look at March and April, this is the latest data we have, and we look at these 5 different sort of industries: hotels, tourism, entertainment, transportation, restaurants and bars, and retail, food and beverage. All together over those 2 months, which is really sort of mid-March through end of April, almost $11 million or 11 million jobs lost in that period. When we look at it more granularly on page 29, this is 20 industries that we've zoomed in on. It's basically, again, over that same 2-month period, 15 million jobs lost, but I think importantly, $476 billion of income lost as a result of all this. And so that's why when we talk about that fiscal support and getting checks into the hands of individuals, that's to make up for basically this income being out of the system and spending going down as a result. Now, switching to the business side on page 30, here we see a measure. It's a Bloomberg Corporate Bankruptcy Index. And this is just sort of confirming what we would expect. We expect there to be increased bankruptcies in this environment. And while it will likely go higher, you can see a little jump as this index has made its way into 2020. So we expect that to go higher. Similarly, what we're expecting from companies is to see dividend and share buyback eliminations, cuts, or suspensions. And so just by a variety of measures, we're seeing that jump up here in 2020. And when you roll all this up in terms of, I guess, and take a step back on the economic impact, we look at this and see a wide range across a variety of firms in terms of what people think, but the pattern's all there. A negative result now we see as an initial estimate in first quarter of down 4.8%, and then everybody's expecting a big decline in the second quarter and then recovery in the second half. The other thing I'd point out, by this measure, this consensus estimate of a 5.7% decline for 2020. So again, pretty intense volatility in the economy and recovery in the second half is what we're seeing. Now, one of the ways that's all going to happen is through earnings. So page 33 shows an exhibit we've looked at before. Basically, the green bars showing the quarterly estimates for the S&P 500 earnings as people thought about it at the beginning of the year, and then estimates as they think about them now that we know all that's going on with this virus. So essentially, huge decline in expected earnings, and we're expecting earnings to decline through the year and start to make their way back towards even by the end of the year. And then 34 sort of breaks it down by industry. Same measures on the right side, sort of where what we were thinking at the beginning of the year roughly, and then what people are thinking now. And you can see, of course, industries like energy, or sectors, consumer discretionary, industrials, all getting hit pretty hard, which is not surprising given all that's going on. Now, I mentioned dividends and share buybacks, and we have to be mindful that this is an important component of equity returns, right? So this is just showing sort of the measures of sort of contribution, if you will, of dividend and buybacks to a stock's experience. And it's an important thing to consider. And so again, as a company either eliminates their dividend or decides not to buy back shares, that could have a downward pressing sort of force on stock returns. Now, as it relates to the overall recovery, we've talked over the last month or two about the shape of the recovery, an L being a drop in stagnation, a U, a drop, some stagnation, and then recovery, and then a V, quick drop, quick recovery. We think we're kind of in between a U and a V. We think there will be recovery in the second half, and some people have talked about the swoosh, a quick drop down, a start of a recovery, but then a sort of a slower move that ends up accelerating. So again, we're watching it. We'll all see what happens as a result. Now, switching gears to the presidential election, I said last month, I'll say again, this is important in the sense that, of course, it defines the leadership in the executive branch for our country. And so we're going to watch this very carefully. We think it's very much a toss-up at this point and very much a function of how things unfold between now and November and the election itself as it relates to how people are feeling about any recovery we see from coronavirus and the crisis here. Now, finally, looking at our scenarios, we have three scenarios that we've modeled. Our base case, which is modestly positive, we think the opening up of the businesses and the economies is happening here in May, is going to continue into June and beyond, and that's going to lead to economic recovery in the second half, and it's going to lead to earnings rebuild, if you will, in terms of companies. And that's a function of us being able to get businesses back online while keeping the virus reasonably under control, and also a function of a rebuild, not immediate, but a rebuild of consumer confidence. Then we have two other scenarios. Our bull case, which is going to be triggered by either the reopening going quickly and still keeping the virus at bay, and or, for example, medical innovation that will help accelerate it. But the bull case would mean a quicker recovery, markets coming back even stronger. And then the bear case is, well, we try to reopen, we don't have any medical help, if you will, and the virus returns and we feel like we have to move back to shutdown. So again, three scenarios that we model, that's how we're thinking right now. Now, I want to sort of close last section with our guidance on asset allocation. And so page 40 shows in equities what we think. And I'll remind people the way we've been thinking about this is we want to move towards quality in terms of financial strength of companies and all that, and kind of avoid sort of the stress that might be happening as much as possible. So the net result is we've gone overweight large cap. We've gone over, let me start with this, U.S. versus non-U.S. Then within the U.S., overweight large cap and overweight large cap growth within that. And we think that's important in terms of sort of, again, focusing in on companies that are going to be a little bit stronger in terms of quality, et cetera here. And then, as it relates to non-U.S., we essentially took our overweight off in terms of Europe. Now we're basically neutral around the world. And then within fixed income, a couple subtle points. We're modestly underweight duration. That's because rates are low. We do expect them to trend a little higher, not dramatically so, but a little bit. And then we're modestly overweight higher grade corporates. Basically, we think that there was a lot of opportunity created from all this stress, and that that segment of the bond market will do well in the taxable bond space. So let me close with page 42, just a reminder for those of you that have the slides themselves that we do a significant body of work for you, our clients. And essentially, this page just sort of lays it all out with links that will take you to the different work. And so we invite you to sort of navigate around and check all that out. It includes this strategy brief video and corresponding podcast. And so we do appreciate your consideration. Thanks so much for watching this month, and we'll see you next month.